All right, ladies and gentlemen, good morning and welcome. This is first in the series of untangling some of our tax laws. Um, and just recently, we had some regulations come in for RMDs. Uh, so we thought that we'll talk about that and and we'll see how if there are any questions. Um, so with that, let's kick right in. I know the topic is a little heavy when it talks about the required minimum distribution. Um, so we'll try to keep it light as light as possible, but at the same time, we still have to gloss over some of the tricky aspects of the Secure Act and stuff like that. So let's dive right in. My name is Pranav Shingala. I work in Prudent Prosperity and Prudent Tax, and we'll go through the further introductions. So here is the agenda. I'm sharing my slide. If any of you are not able to see it, please let me know. Raise your hand, give a reaction, and I'll be more than happy to kind of make sure that you're able to see it. So in terms of agenda, what we're going to cover in next 1 hour is first go through some introduction and the disclaimers, then touch upon some of the key concepts which we have to kind of to understand this and to get the context about what RMD is, etc., some history behind these changes, and understand some critical definitions. And then we'll also get some essential reminders that what you need to kind of keep in mind when you are kind of thinking about retirement accounts, planning the beneficiaries, appointing the beneficiaries, etc. Then we'll touch upon the final regulation on the RMDs, which just came out last week on July 18th. I want to say July 18th morning. We'll get to the bottom line of the whole discussion towards the end of it, and then we'll leave some time for Q&A. Hopefully there's a way for you to kind of put in a question in there, and there should be a chat box, and we'll open that up for the Q&A towards the end of the day or end of the session. So let's jump right in. Next up is some of the disclaimers that our legal and compliance team mandate us to kind of talk through that. It's just primarily legal mumbo jumbo in terms of the, hey, this is purely an information purpose only. Maybe some of this might be entertainment as well for you because there's just plenty going on. Congress stuff is involved. None of this presentation is a tax advice or an investment advice. If you were to act upon any of this, we would recommend that you discuss with your qualified tax professional or the investment advisor before making any decisions purely based off of this presentation. Some of the information that is shared is kind of sourced out of different documents. I have kind of shuffled through the hundreds of pages of documents. So the accuracy of this information is purely, kind of from my standpoint, and I'm human. So there could be, if there are issues or if there are questions, feel free to bring it up later and we can talk through in detail. If there is anything where you require more guidance, please consult with your professional if you have one, which is tax professional or the investment advisor. All right, let's move on. Let's keep going. Let's get the introduction in. Like I mentioned, my name is Pranav Shingala. I am FINRA and Texas State Registered Investment Advisor. I have about 20 plus years of experience in financial services and investment management industry. Worked with Goldman Sachs for about 10 years, and then I kind of started off independently into the investment advisory world. I got all of my licenses. I also have 10 plus years of experience in tax planning, retirement planning, and portfolio management. I'm based out of Dallas, Texas, and most of our clients or associations are within the state of Texas. But we are more than happy to kind of branch out if there is any need. But as of now, our company is Prudent Prosperity. You can visit us at prudentprosperity.com. That company purely focuses on the investment management, tax management, personal financial planning, and estate planning for our clients. Our other company, which is Prudent Tax, you can visit that at btaxsavvy.com. Prudent Tax focuses purely on the tax preparation, tax filing. If you're forming a new business, we can focus on that. We can do the cash flow management, which is like a fractional CFO kind of a service, and also just usual bookkeeping, payroll, any of those services that you might need. So that's the introduction about me and our companies. Do visit and leave a note, and we'll be happy to help you anytime. All right, let's get into some of the key concepts, the history, and the definitions of about everything about this required minimum distribution. So we're going to touch upon these key questions, which is, what are these RMDs, required minimum distributions, and then what's all this noise about lately or last few years? What's going on? We're going to touch upon RMD age, when the RMDs are due, some key dates, and the timeline questions. We're going to talk about how to calculate RMDs. If you are reaching the senior age, if you are heading into the senior years of your reaching the RMD age, then we'll talk about how to calculate it. We'll also talk about what are the tax implications, how the RMDs are taxed, and how IRS looks at it. All right, so let's talk about what the RMDs are and what they are. So in terms of the required minimum distribution is purely it's a minimum, and like I said, required minimum distribution, RMDs, they are generally called as RMDs, so used interchangeably. That's the money that must be taken out of your retirement savings plan, and more specifically, the RMDs are the minimum amount that must come out of the given retirement plan accounts each year once the account holder reaches a certain age. So let's chew on that a little bit here, that what we're talking about is, there's an applicable age towards the end where I'm saying that, you have to reach, let me get my laser pointer out here. If you reach a certain age, so we're going to call it an applicable age. Once you reach that certain age, and we're going to talk more about it in a little bit, once you reach that age, you have to start taking money out of your, whether it's a 401k or a traditional IRA or 403b or any of those qualified accounts. So that's the requirement here. That's what we are talking about purely. The second important point is it's calculated based on a formula, and generally it is designed by the IRS and the Treasury Department. It's designed to ensure that retirees, the folks who are reaching 70, 72, 73, 75, the retirees are gradually drawing down their retirement savings and then paying taxes on those funds as they withdraw them. So that's the key part where what's required as part of the RMDs. So the key points, due to the Secure 2.0 Act, the RMD age rose from 72 to 73 in 2023, and it will rise again to 75 in 2033. So we'll talk about that a little bit again in detail. The RMD rules generally apply. Generally, they apply only to the employer-sponsored retirement plans, such as 401ks, 403bs, 457bs. In addition to that, it also applies to the traditional IRAs. The IRS says the RMD rules also apply, and this is another key point to remember here, that the RMD rules also apply to some of the qualified plans, which are SEP IRAs or simple IRAs or SAPs. We call them SARSEPs. SARSEPs IRAs as well. So keep in mind, this is how the required minimum distribution is kind of calculated, or at least these are the kind of important aspect about it, that you have to take minimum distribution once you reach the applicable age, and we'll also talk about those applicable age. Let's move on to the next slide. Um, and so what's all this noise about RMDs? And this is interesting, right? Let's go back to where it all started. This whole thing started in 2019, where Ways and Means Committee Republican leader Kevin Brady, he's a Republican from Texas, and Chairman Richard Neal, he's a Democrat from Massachusetts. They introduced a bill called Secure Act. Congress likes to pass these kind of acts where acronyms like Secure Act. It stands for setting every community up for retirement enhancement, just in case if you care about it. So the Secure Act was passed, believe it or not, just in December of 2019, and as part of the Secure Act, there were some sweeping changes that were proposed, or those legislations came into practice, which impacted post-death tax treatment of qualified retirement accounts. What do I mean by that? The impact came to the majority of the impact was given to the, what happens to the retirement accounts once somebody passes, and the tax treatment of that. Now, keep in mind, this happened, all of these, note this, that this was all passed in December of 2019. And at the time, in 2019 or January Q1 of 2020, every CPA or enrolled agent or investment advisor or even a CFP, they just thought that, hey, we'll catch up on all of this stuff when we have to go through our continuing education during our year 2020. So we'll read through it as part of continuing education, and we'll just familiarize ourselves with that. But then, as we all know, what happened in 2020? COVID-19 hit, and then 2020 pretty much never ended. Like, all the CPAs and EAs were constantly busy with PPPs and ERCs and every new jargon scheme that was thrown out while COVID-19 pandemic was spreading through the country. So the problem was nobody really got around to the new legislation, and there was a lot of confusion around it, which we'll talk about in a little bit. So in short, all of this noise is purely because of the timing when the Secure Act was passed, and also in the way it was passed. Like, there was a lot of confusion, people didn't understand it, and then there were a lot of IRS notices floating around between 2020 and 2022. So we'll talk about all of that, what happened and stuff like that, right? So let's keep going. Let's go to the next slide. So RMD age, the other question that we have is that when are the RMDs due as per the Secure Act and as per the IRS? So one of the key dates that you need to remember is April 1st. April 1 is your key RMD deadline. What do I mean by that? Is that if, let's say that you are 72 years of age, and you are approaching you are in the applicable age of your RMD to begin this year, or let's say it happened last year, 2023. What IRS or Secure Act allows is that you can delay your first RMD until the April 1st of the following year. And we'll talk about this in a little bit. We'll crystallize that even more. So what happens is that, delaying the first required distribution. Now, when you delay that, what could result is you may end up having sometimes two distributions that you may have to take in the year. Let me give you an example so that it makes it easier for you. If you reached an age of 72, let's say in 2022, then you should have taken your first RMD for the year 2022 on or before April 1, 2023. So not you reached your applicable age in 2022, but you chose not to take your RMD in 2022 because the law allows you to push it to 2023. So you pushed it to 2023. Let's say you took it in March or April or March of 2023. But then you also have to keep in mind your second RMD for 2023 is also due, which is your subsequent RMD. That's due by December 31st of 2023. So essentially what's happening is you in 2023, you would have taken two separate RMDs, and that would be your income. So that's another critical key point to keep in mind, that your key deadline, and this applies, the April 1 applies for your first required RMD. So that's a key. Let me get the highlighter here, that the key date here is for the first RMD. All your subsequent RMDs have to be made by December 31st. Then April 1 goes out of the window. It's only for the first year. Just IRS and Secure Act gives you that only for the first year. All right, let's keep going now. Now it's going to get even more interesting, and you'll see that how the Secure Act was passed, and then some of the confusion was caused. So let's look at some of the ages and by when do you when you reach your applicable age. So the people who were born before July 1, 1949, the applicable age is 70 and a half. So you have to be 70 and a half. Once you reach 70 and a half, and this ends up being somewhere in the timeline of you would be about 70 and a half. If you turn 70 and a half in the year, let's say 2020, then that's your applicable age, and that's when you should have started your RMD. But then that was around the same time, which is 2020, is when Congress changed the law. And then they were like, oh, wait, you know what? For people born after July 1, 1949, but before January 1, 1951, the applicable age, we're going to change it to 72. Okay, all right, so far so good, no issues there. So that's for the folks who turned 72 somewhere between 2020 and 2022. That's for them. So anybody who turned 72 during last couple of years, for them. Then they added another change in 2022, and again we'll talk about that, for the participants who were born after Jan 1st, 1951, but before January 1st, 1959. So that's for almost about 10 years, or about 8 years there, where they said the applicable age is going to be 73 years. Okay. And then they said for participants, everybody who is born after Jan 1st, 1960, the applicable age is going to be 75. So this comes into effect, I think, not until 2033. So everybody who turns 75 or after 2033, the law is going to be required, and RMD is not required until you turn 75. So this we'll worry about in 2033. But if you look closely, they made a huge error here in passing the law. They just eliminated the entire 1959. So let's look here. They said Jan 1, 1951, but before Jan 1, 1959. And then they straight up jumped to anybody born after Jan 1, 1960. Hey, what happened to the guys who were born in 1959? So under the new proposed final regulation and the Secure 2.0, the applicable age for the participant born in 1959 would be 73. So finally, they clarified that because they had to fix that, because the way the laws were passed, Congress kind of haphazardly put some documents together, and they didn't really look through it. But that's where we are. So finally, they have clarified this, that for people born in 1959, it's 73. When they turn 73, they need to take their RMDs. All right, let's keep going further, and we'll talk a lot more about this. So if this is too much to process, it's okay. Take it easy. We'll crystallize it even more. We'll gloss over it a little further. Let's talk about how to calculate the RMDs. While all of this process of calculating RMDs and when you reach the age of RMD and all of that may seem very mysterious, but the methodology around the whole thing is actually very simple. I like to kind of simplify this as much as possible. So your yearly RMD is calculated using a formula. That's the formula is based on IRS's Uniform Lifetime Table. So the Uniform Lifetime Table looks like this. What you see on the screen. There are more rows to it. It keeps going to like age. I want to say like 90 or 92. And it keeps giving you a distribution period. Now, this table is put together by actuarial calculations. So what I mean by that is the actuaries, who are the professionals, they have put together by looking at the projected life expectancies and inflation and whatnot. So basically, this table that you are looking at, that's the table estimates the maximum number of years. It's also known as the distribution period right here. That decides your retirement account may need to make RMD. So the number of years that, how much distribution you have to make for between you and your spouse or surviving spouse. So how do you calculate your RMD for a given year? Let's just say that, that's arrived at simply by dividing the value of your retirement account at the end of the previous year by the distribution period based on what your age will be in the year you take the RMD. So let's give an example here quickly. That if you turn 73 in let's say 2024, and this is the year you have to take RMD, and you have you have, let's say, about 500,000 in your IRA account at the end of last year, because remember the caveat is at the end of the previous year. The balance has to be at the end of the previous year. So as of December 31st, 2023, the balance in your traditional IRA is $500,000. And you turned 73 this year, so you have to start taking your RMD. So your distribution period, you have to distribute that over 26 and a half years. So that $500,000 will simply get divided by 26 and a half. That gives you the amount of about $18,867.92, or let's round it up, $18,868. That's the amount you have to take for in 2024. Now, keep in mind, if you are turning 73 this year, and if this year is your year one, you don't have to take it this year. If you want to, you can. But if you want to push it to next year, anytime before April 1, you can. But if you do that in 2025, let's say you want to take it in March of 2025, you can do it. But your year two of 2025, the RMD will also be due in 2025. So you will have to take 2 RMDs next year if you choose to push this year's RMD to next year. That's a caveat. And then next year, you would do the similar exercise. When you turn 74, you will take the balance in your traditional IRA account at the end of 2024. You will divide that amount by 25 and a half. And every year, and most of these calculations are generally done by the participants, like your custodians, Fidelity and Charles Schwab. These guys are pretty good at kind of giving you the notifications that, hey, you are coming up to the age of RMD, this is your RMD amount, etc. So you don't have to worry about that. But one key point to keep in mind: higher returns will equal higher RMDs. What do I mean by that? And how is that? Again, very simple. If a significant portion of your IRA and a 401k accounts, if they were invested in the stocks, chances are that the value of your retirement portfolio ended the year between 8 or 13% higher than it was at the end of 2022, and purely because the S&P 500 ended 2023 with a total gain of almost about 22% plus. So, remember, keep in mind that every year you have to take the balance in your IRA account. You take a stock of it. So if your IRA account has appreciated by 22%, then your RMD is going to go up by pretty much that much, because the balance went up. So now your common denominator, when you're dividing that, that the years are standard, your distribution period. The amount in the account is the one that keeps changing. So 2023 was a good year. 2024 so far has been a good year. So again, it's going to be high return year or high RMD year for the folks who are in the age. All right, so hope that gives you a perspective on how to calculate the RMDs and how the returns impact your RMDs. Let's keep moving. How the RMDs are taxed. RMDs are taxed typically, just as regular ordinary income. So there's no rocket science. It's whatever the distribution that's coming to you, it's your regular income. You are going to pay taxes as you normally would for that year. The point is that in all of these accounts, the RMDs are coming out of your pre-tax amount account. So you have never paid taxes on those amounts that you contributed. And now when the RMDs are coming out, now Uncle Sam is going to go back in your pocket and be like, hey, you got to pay tax on it because you never paid. So simple truth, RMDs are taxed as ordinary income. And if you do in your RMD years, if you have other incomes, then it makes more sense to kind of have a proper planning around how your income is distributed over the period of time. If you fail to take the RMDs on time, or even taking the correct amount, if you don't take the right amount out, it could result in substantial IRS tax penalties. So keep in mind that follow the RMD regulations. Don't skip a year. Don't reduce the amount. Just follow the guidelines. And if you're not sure, consult a CPA or investment advisor to help you out. There are some common strategies where you can minimize the tax impact of your RMDs. Some of them are, you can do qualified charitable distribution, so you can kind of donate to some or all of your RMD amount to eligible non-profit organizations. That's one of them. You can also consolidate all your various retirement accounts into one, because sometimes what happens is you have too many accounts, retirement accounts like 401ks, traditional IRAs, SEP IRAs, blah, blah, blah. Multiple accounts results into multiple RMDs that you have to take from each one of them. So it makes more sense that as you reach your age, the applicable age, right? You want to kind of make sure that you consolidate all of that. You could also do Roth conversion. So if you are taking the RMDs, you can convert that money, your required amounts, into Roth conversion. So there are some guidelines around it. I mean, it's not simple. Just take the RMD and put it to Roth account. It doesn't work like that. So but there are ways. And you can also look at some estate planning where you can help minimize the tax burden on your heirs or the beneficiaries, because if you are in the senior years and if you got a big nest egg sitting in your retirement account, and if you think that you're not going to be able to use the whole thing, prudent thing to do would be to get with an estate planner, decide that how you want to distribute that out to the beneficiaries or your heirs by having a minimum tax impact to them. While you are trying to save on taxes, you don't want to kind of put that entire burden on your heirs or the beneficiaries either. So that's on how RMDs are taxed. Again, we have just glossed over the surface of it. We haven't really kind of going to the depth of it. There is a lot more to it than what you can imagine. So consult professionals. Let's look at some of the definitions real quick, which are really important for you to kind of know. So applicable age, we touched upon this a little bit, that the year for which your first RMD is due from your own retirement accounts. So not from your inherited account. So if you're young and you inherited somebody's retirement account, there's no applicable age for you in terms of RMDs. But when we're talking about RMDs, your applicable age is what we discussed in previous slide, that how Secure Act defined it: 70 and a half, 72, 73, or 75 starting 2033. Those are some of the applicable ages. So first thing you need to know is what's your applicable age. So if you are in 70s, if you are in late 70s, anywhere 72, 73 currently, you want to keep in mind that what's your applicable age. And let's move on to the required beginning date. The next definition that we want to kind of keep in mind is what's your required beginning date. We talked about that a little bit as well earlier, that key date to keep in mind when you reach your applicable age. That means if you are reaching 72 or 73, then the key date to remember is April 1st. April 1st is of the following year is by when you have to take your first RMD. If you don't, then you have penalties around it. So keep in mind, required beginning date is another important point. So if you understand applicable age and if you understand required beginning date, then you'll be able to understand a lot of other concepts very, very easily about every law that revolves around the RMD. So let's recap again. Applicable age is the age when you are reaching the RMD age, when you have to start having the RMDs out of your retirement accounts. And that applicable age is different based on the year you were born in, which we kind of touched upon in the previous slides, that the 51, if you were born in 51, 52, 53, so on and so forth. And anybody born after Jan 1, 1960, it is 75. So once you reach the applicable age, then you have to worry about what my required beginning date is. Your required beginning date for the first RMD is April 1. Once that's done, then all the subsequent years is always December 31st. Okay. If we got that down, let's move on to the designated beneficiary. What's your designated beneficiary? Every person who has a retirement account, they have designated a beneficiary on it. If you have a 401k, if I have a traditional IRA, I have designated a beneficiary on it, and that is an individual. So the key term here is having an individual who is designated as by the participant. So you are, in this case, as a participant. You as an individual who has the traditional IRA, or I as an individual who have a 401k, we are participant. And then when we designated another individual, that person is a beneficiary. The use of individual here is intentional here because it excludes the non-person beneficiaries. So as you all know that, you can always assign estates, charities, corporations, whatnot, as your beneficiaries as well. So as the more sophisticated planning goes, to you start doing that. But for our conversation right now, we're going to keep all of those out of the definition. We're only focusing on the individuals. The only exception that's as part of this is the see-through trusts. So certain trust beneficiaries are treated as designated beneficiaries. So in certain scenarios, as per the Secure Act, a see-through trust where the beneficiaries, for example, let's say the beneficiary out of that trust is your spouse, then that trust is also a designated beneficiary. Let's not complicate it. Let's not really kind of think too much about it. It's again technical terms. Not everybody goes through it. But if you are at that level where you have millions and millions of dollars in your retirement accounts and you want to do some trusts and charities and corporations, we can sit down, or you need to sit down with your CPA and or the investment advisor and talk through that. But for now, let's just focus on the individual. Let's say that the daughter is the beneficiary or wife is the beneficiary, right? Those simple common man scenarios. The eligible designated beneficiary. What's an eligible designated beneficiary? The designated beneficiary who at the date of participant's death. So if anyone who is 72 or 72 plus, 73 plus, they have a beneficiary designated on their retirement accounts. And if any of these conditions are met at the time of that participant's death, then they are eligible designated beneficiaries. So it's the surviving spouse of every participant is always an eligible designated beneficiary. In most scenarios, spouse and the children of the participants are always eligible designated beneficiaries. Anybody who is disabled and mentioned as a designated beneficiary. Anybody who is chronically ill and mentioned as a designated beneficiary. And keep in mind, this is another very key term here, not more than 10 years younger than the participant. So if you have your spouse listed as your beneficiary, but if your spouse is more younger than 10 years, so the gap between you and your spouse is more than 10 years, then your spouse is not an eligible designated beneficiary. Keep this term in mind. This is very, very important thing because we will talk about that in a little bit. So we're going to fast pace this. We have about 17 minutes left, and we still have a few more slides to cover. So the joint, so we talked about a uniform table for the calculation, uniform lifetime table in the previous slides. There are other tables also that IRS has published, which is joint and last survivor table. So remember, we talked about that if your spouse, the gap in the age between you and your spouse is more than 10 years, then your spouse will have to use a table which is joint and last survivor table. So, if you read the definition, this table is used to calculate RMDs for the participants whose spouse is their sole primary beneficiary. So if your wife or a husband is the only primary beneficiary and the gap is more than 10 years. So if they are, and actually not just gap, but if your spouse is younger by more than 10 years, then they have to use a different table. They cannot use the table that we discussed here. This is not the table that applies. But again, I mean, you don't have to worry about all of this. I'm just giving you the information for your knowledge as part of the definition. Single life expectancy table. This table comes into the picture only for the beneficiaries who inherit their who inherit a traditional retirement account from the beneficiary. So, for example, if I pass and my beneficiary is my wife, and if my wife also kind of eventually or the beneficiary also passes, then it goes to somebody who is inheriting at the third level. That's a successor beneficiary. So they will have to use the single life expectancy table. So it gets complicated once you kind of reach those levels. But again, I mean, to plan all of that, you need an expert. So let's keep going. This is purely the definitions we were talking about. Some of the essential reminders, we're going to quickly go through this. Keep in mind, we only have 15 minutes. I want to leave some time. So the Roth account, the owners or the participants of the Roth accounts are not subject to RMDs. So if you are saving or contributing to a Roth IRA, you are not subject to RMD. So let's have that quick reminder there for that, right? So for designated Roth accounts like DRAs, which are like Roth 401k, 403b, the new rules are effective from 2023 for that, no RMDs. So, but as a result, the rules that apply to the beneficiaries of the Roth IRAs and the DRAs for 2024 and after, the same as those that apply to the beneficiary of the inherited traditional account. So if somebody inherited a traditional IRA, or if somebody is a beneficiary on a Roth IRA, the rules are pretty much the same. So that gets a little complicated there. So if you are a beneficiary listed on a Roth IRA, and if the RMDs have, supposed to have started, I mean, if the person who died, they should have started taking the RMDs, then the rules are different. So keep that in mind. So employer plans, we talked about that. The 401ks, 403bs, those are the qualified plans. IRA owners and the employee plan participants. So everyone who contributes into the for this presentation's perspective, anybody who contributing into the IRAs, we'll call all of them participants. All right. Now we are into the meat of the matter, which we wanted to talk about, which is the final regulation. The final regulation, how did we get here? And we touched upon this a little bit. And all of this started in 2019, where Secure Act was passed. We talked about that a little bit there, Texas Representative Brady and Kevin Brady and Richard Neal from Massachusetts, they passed Secure Act in December of 2019. They eliminated a stretched treatment of the post-death distribution. I'm just going to simplify that for you guys, that if back in the days, I can put my 6-year-old great-grandchild as the beneficiary on my traditional IRA, and the life expectancy of that child will apply, and that means my retirement account will live for another 70, 80 years, as long as that grandchild is alive and taking the RMDs. So, if I'm leaving a few $1 million in my retirement account, and if I'm leaving the beneficiary as like a 6-year-old grandchild, then that money can live on for a few years. So that was called a stretch treatment. They eliminated that in 2019. And then they eliminated that stretch treatment. So they said, Congress said, all right, stop all of that. You guys cannot put like little kids or somebody who is like, eligible, but you are just stretching the entire IRA or the retirement accounts for like years. You cannot do that. They put a 10-year rule on the non-spouse beneficiary. So anybody who is beneficiary who is not a spouse, they just put a standard rule saying that 10 years, that's it. You start taking the RMDs, and at the end of the 10 years, that retirement account has to go to zero. That's it. They put a rule like that. But all of this had a lot of confusion, because remember, this happened in December 2019. 3 months later, in March of 2020, the entire country was in COVID-19 pandemic. CPAs, EAs, nobody had the time to look through all of these massive sweeping changes that they made. And so there was confusion going on. Then they came out with, in 2022, they proposed some regulations on top of the Secure Act, and they dropped a bombshell saying that, hey, remember we put a 10-year rule that the retirement account has to go to zero in 10 years. Well, on top of that, you are supposed to be taking the RMDs during those 10 years. So between this 2020, 2021, 2022, all of these years, CPAs and EAs were thinking that, hey, you know what, this 10-year rule, what all it's saying is that you have to take all of this money out of the retirement accounts in 10 years or by the end of 10th year. So most of the people, what they did is they kept the money in the account for 10 years and they took it out at the end of the 10th year, because why not? I'm not required to take it out, because that's the interpretation everybody had. Congress clarified that in 2022. Sorry, you guys are doing it wrong. You have to take your required minimum distribution during the 10-year rule every year. Okay, more confusion. All right. Then came December 2022. Again, Representative Brady and Kevin Brady and Richard Neal, they passed Secure 2.0 Act. Again, they kind of added a lot more terms where they added like charitable organizations can be designated as the beneficiaries, especially if you are doing a multi-beneficiary trust. We'll talk about that in a little bit. Then they allowed the participants who, if your employer plan allows the annuities in your retirement account, then you can club your annuities as part of your RMDs. So they added that. And then the Congress kind of, I think around this time, what I understand is Kevin Brady was not running for re-election. So he's like, he wanted to 2022, he wanted to get this bill passed. And in that rush, they made a massive drafting error and they just eliminated everybody who was born in year 1959. They just did not account for it. So even more confusion happened after Secure 2.0 Act was passed. So if you really look at where we are today, that's a result of December 2019 till July 2024, when the final regulation came out, clarified everything, and explained everything that, okay, guys, this is what it is, and this is what you're going to follow. So let's talk about what we are today, July 2024. On the 18th of July, just last week, the final regulation came out, and we're going to talk through that now. So we're going to gloss over this quickly again, we, in the interest of time, but what we want to focus on is the left half of this chart. If you are a beneficiary on somebody's IRA, let's say that you are a spouse, you are a spouse, and your husband or your wife has listed you as the beneficiary. You are automatically here, which is eligible designated beneficiary, the surviving spouse. So now we are talking about the scenarios where the participant, the owner of the retirement account, in this case, you are, let's say, for example, you are a beneficiary and your spouse is the participant, right? If your spouse passes, who is the participant, then you now have to look at two different scenarios and decide that what applies to you. Now, if the owner or the participant of the retirement account died before the RBD, remember what RBD is, which is the April 1 of the following year of the applicable age. Remember, we said that you have to remember just two definitions. And if you got those two definitions right, applicable age and the RBD, you got the entire RMD regulation down to kind of to the T. So let's talk about this again. If the beneficiary is a surviving spouse and the spouse who is the owner of the account passed before the RBD started. So in current scenario, if the spouse is 73 years of age and passed and the RBD has not come, which is before that April 1, then you can you as the surviving spouse can stretch the whole retirement account to your life expectancy or to your spouse's life expectancy, and you don't have to worry about anything. You just have to follow that distribution period. Remember that table that we talked about. Or you can also apply a 10-year rule. So you have options. You can use the entire retirement account as a beneficiary in the 10 years by taking yearly RMDs. Remember that they clarified that, hey, 10-year rule, the RMD still applies. Or you can stretch it out and not do 10 years, and you can do, like, let's say 26 years, depending on where you are as a spouse in the age. So that's that. Now, the other scenario could be that if your spouse died after the RMD started, like after the RBD, which is the required beginning date, then you have to just follow the stretch years. Stretch years means that the distribution table, which we discussed in the previous slide. Let's go back quickly and show you again that this is the table you would follow, because your spouse already started it before passing, and now you are the beneficiary. So you have to continue to follow the same schedule. So let's go back to the diagram again, and we're gonna, like I said, we're gonna focus on just the left side of it, and we're not gonna focus on some of the charities and estates and complicated stuff, because that requires more discussions. All right, so let's make it simple. If you are the surviving spouse and you are the beneficiary, and your spouse, who is the owner of the retirement account, passed before starting the RMD, before their RBD date arrived, then you have two options. You can either stretch it out to the distribution periods, or you can take it within the 10-year rules. Options. Keep in mind, there's an or. Or the second scenario is if your spouse passed after the age and after the RMDs have started, you are the surviving spouse and you have to take then you have to follow that. If you got these down, this is the most common man scenarios that we come across. So that's the most important part. So, if there's confusion, send me an email. I can spend more time with you, and we'll talk about it. We still got a few more slides to left, and we might have to go over a little bit, but I want to make sure that we started about 5-7 minutes late, so we might go over. If participants are okay staying over, you guys are more than welcome to stay on. Let's continue. There are non-eligible designated beneficiaries out here, where there are non-spouse beneficiaries can be assigned as well, which I mentioned earlier, that see-through trusts and all of that. In those cases, the similar conditions of the RBDs, but they cannot get around 10-year rule. They cannot go to the stretch. They cannot. Only in the case of if the account owner or the participant has started the RMD, then that goes through the non-spouse beneficiary can use a stretch, especially in some exceptional scenarios. But again, it gets more complicated here, and we don't really have that much time to talk about all of these technicalities. But if you understand this green box and the two below that, you are way ahead of I want to say 80-90% of the population already. So let's keep moving. Let's go to the next slide quickly, and let's talk about more fun stuff that's been included in the final regulation. No RBDs for the plan participants whose only funds are in designated Roth account. We talked about this earlier, that RMD requirements do not apply to the Roth accounts. So it's the same thing, reiteration of that. Let's talk about the new rule allowing the individual RMD treatment for the trust divided on death. What do I mean by this, or what do they mean by this? This is not my regulation, this is their. What does Congress mean by this? The prior rule, what they were doing is that if you have a trust, a see-through trust or anything, right, you are only the distribution is applicable to the tenure, or you're limited because now you have just the limited time frame. But the new rule, what it is saying is, if you structure your beneficiary structure in a way where on your death, that beneficiary trust. So let's break it down quickly in an example. If I have 3 kids, if I have A, B, and C, 3 kids, and they are all, let's say, 35, 25, and 35, 30, and 25. Let's say 5 years. I can have all of their 3 named trusts listed under the beneficiary trust. So I have a retirement account where I will put a trust as the beneficiary, and then that trust will have 3 different individual separate trust for each of my kids. And the structure is such that the day I pass, that trust gets dissolved, and all of that assets within that trust will get distributed equally to those 3 trusts of the kids. Now, if you do that, what's the benefit of that? Why would you want to do that? If you do that, then what happens is that each kid will be able to apply their own age for the distributions. Let's cycle back a little bit. That if I put all 3 kids into one, let's say that a 35-year-old, 30 years old, and 25 years old, what they do is they take the shortest distribution cycle as per the prior rule. Let's highlight that part here. That prior rule said that if you have multiple kids as the beneficiaries, then they are going to take the shortest distribution cycle. In that case, the kid who is 35 years old, his or her distribution cycle will apply to all 3 of them. So in this case, the kid with the 25 years age, he's losing out because he's like, hey, what's my fault that I'm the youngest and I got the short end of the stick? So they fixed it. They put a new rule and they're like, hey, if you put the individual trust for each of the kids, then each of them can have their own distribution schedule and they can all be happy. Plus, they all can avoid the family fights. They can invest the way they want to do it. So this fixed a lot of those issues out so that, the younger brother is not attacking the older sister or something like that, where, those issues were taken out of the RMDs. All right. So that fixed that. Annuity payments, we talked about that the annuity payments can count against your RMDs. Annuities assets can be used against the asset calculations. Again, we have gone over that a little bit. Any part of the distribution that's treated as the RMD is not eligible to roll over into a retirement account. Keep in mind, you are taking the RMD out of your qualified account and you cannot roll that over into another retirement account. It's not allowed because you have to take it as a distribution and show it as an income and pay taxes on it. If you try to roll that over, that's going to be fraud. You're going to have penalties. Don't do that. However, if you have a distribution coming out of the designated Roth account, and if your RMD age has reached, and you are allowed to do the RMDs and all that, then you can do that distribution. You can roll that over into a Roth IRA. Okay, so that's that's a caveat to keep in mind. All right, another special rule that's important. Remember, we talked about those trusts where I said I have 3 kids, and and let's say that if I had another charity that I was interested in, let's say church or a temple or something. But then what happens? Let's say that I'm splitting my retirement account 4 ways: 3 kids and a temple or a church or a charity of my liking. What happens is, if that church remains if I pass and the distribution has to happen, then all the kids, including the church, will get into the 10-year rule. Everybody will have to do the 10-year RMD because the church or the temple will make that compulsory. So in this case, what IRS and the regulation said is that, hey, if you pass in 2024 or whichever that year is, you have until the September 30th of the year after to make changes to your appointments of the trusts. So net, what I can now do, I mean, if not me, but the person who is now in charge of my estate can do is, before, let's say that if I am the participant of the account, and I'm the age of 73, 74, and if I pass and I'm doing the RMDs and I pass this year, but I have 4 trusts, 3 for my kids, 1 for the temple or the church or the charity. But because the temple or the church will put everybody into 10-year rule, if I tell my surviving spouse or somebody or my investment advisor knows this really well, what they will do is they will take that church or temple out before the September 30th of the next year, so that kids can follow their distribution cycle, which is distribution schedule, because kids can distribute it over, let's say, 20, 30, maybe 40 years, depending on their age. And very, very important piece, last piece is on this slide is IRS has already waived, because remember we went through all these complications that they caused from December 2019 confusion, 2022 confusion, December, because of all of these confusion that they have caused in last 4 years. IRS has waived the annual RMD requirements for year 2021, 2022, 2023, and also for 2024. So anybody who has reached the age of 72, 73, or even, I think 72 and 73 is what applies in these years, you did not have the RMD requirement because either you were confused what to do, or your investment advisor was confused, or your CPA was confused as to what to do. So the rule doesn't apply. But so to RMD, your requirement is waived. But the caveat here is if it is gone to the beneficiary, the surviving or the designated beneficiary, and if anybody is in the 10-year rule, if your grandma or grandpa passed in 2021 and now you are the beneficiary or you have inherited it and you haven't taken the RMDs in last 4 years, and if you are applicable to 10-year rule, now you only have 6 years to take it all out. You don't have the penalties for not taking the RMDs for the last 4 years, but now you only have 6 years. So it's a double whammy, because now you have to do catch up. Like, you will be dividing the remaining balance by 6 years if you are in that issue. So keep this in mind that there are some really, really technical stuff going on here. If any of this is too technical, shoot us an email. My contact information will be there at the end of this. All right. So let's go through this. I'm just going to literally read through this quickly. And first question on the bottom line: are beneficiaries going to be required to take annual minimum distribution during the 10-year rule? The answer is yes. Okay, so if the beneficiary is subject to 10-year rule, remember we talked about the 10-year rule that in certain scenarios you have to take the distributions within the 10-year period. So if you are inheriting or you are the beneficiary, designated beneficiary on the IRA account, you have to start taking that RMDs. The waivers we just talked about, so you can keep the waivers out, but still the 10-year rule still applies. It does not mean that your 10-year starts from 2025. No. If you inherited an IRA in 2021, your 10-year clock started clicking then. It's just that you didn't take the distributions in 4 years. You have to take within that tenure. Who is subject to 10-year rule? Pretty much everyone who is either a non-eligible beneficiary or a non-designated beneficiary. So I would think in a way that if I'm not the spouse, if I have inherited this IRA from somebody, like say grandma, grandpa, or uncle or somebody, then I am pretty much required. I'm pretty much applicable, subject to the 10-year rule. So I have to take this money out in 10 years. If I don't, then there's going to be severe penalties around it. Are Roth IRAs impacted? No, Roth IRAs are not subject to RMDs. Is it not better to just contribute all the required retirement funds into Roth IRA then? I would not have to deal with this RMD headache in all of that case, isn't it? Well, not necessarily. The answer is like, just because RMD or all of this is causing a lot of headache in last few years does not mean that it's not a good vehicle. Look, 401ks and traditional IRAs have been there for years, and they have been there for a reason. People have benefited tremendously out of those. So, just because some laws were passed and regulations were passed haphazardly and caused confusion and some headache does not mean that the underlying investment opportunity is bad. No, the 401ks and traditional IRAs are still a good vehicle for the folks who are able to, for the folks who are eligible for it. But again, consult with the professional, figure it out that if your professional CPA or investment advisor says that, hey, for you, Roth is good or traditional IRA is good or 401k is good, follow that advice and figure your numbers out. All right. Did the final regulation make it easier or more complex how the retirement accounts are handled after the death of the account's original owner? The answer is both. The final regulation has helped solve certain ambiguity that was not addressed in the last 4 years, which we talked about. For example, that people born in 1959, right? Overall, the regulations around how retirement accounts are handled post-death has always been a complex process for the original account owner. That means the participant, the person who is reaching the age of 72, 73, or 75 in next few years. For all of them, it is always a headache that, how my money is going to be handled if I die tomorrow. And I want to do that tax efficiently. Whether you're a participant or a designated beneficiary, make sure to understand what your rights and duties are. All right, I want to read that line again, and I want to kind of put my pointer here that whether you are participant, that means owner, or even if you're a designated beneficiary, make sure to understand what your rights and duties are. For example, that 10-year rule. If you as a designated beneficiary are subject to 10-year rule, you want to make sure what your duties are. Understand those better, because if you don't understand your duties better, you will make a mistake and you will pay a lot of penalties for that. So consult a professional if you're not sure how you want to handle your retirement estate, which means if you are 72 plus in the age, or you are just inheriting somebody's retirement account, you need to know how you are handling those benefits coming to you. All right, so we have handled a lot of questions in the bottom line here. We're going to skip through, we're going to kind of pretty much done with this. I would say the Q&As, I would love to get your Q&As on email because we have already gone 15 minutes beyond the time. Here is the information. Thank you, everybody who took the time out to join this webinar. Really appreciate your time. My name, once again, Pranav Chengala. Here is my contact details. Do drop us an email, info@prudentprosperity.com. You can also send it to pranav@prudentprosperity.com. Visit us on our websites. There will be links to connect with me directly. Block some time if you need more information. Thank you so much, everybody, for joining. And I also want to kind of highlight some of the references where I've gotten all the information from. Some of these links had like 260 plus pages, but I hope this webinar was informative for you. I hope you gained some insight. And thanks once again for all your time. Have a blessed Saturday ahead. Have a great weekend. And we will be in touch with you soon. Thank you all. Have a great day. God bless.